For section 1-3, our learning objectives are number 1, compare and contrast the types of transactions that increase and decrease owner's equity. So we know of one right now. We've had the owner invest money in a company. We're going to learn 3 more today. And then we're going to explain the difference between expenses and liabilities. So it's important to know the definitions for revenue and the definition for sale on account. Revenue is any time you make a sale, whether that's a sale of a good or whether that's a sale of a service, like a haircut. That is called revenue. Revenue is a good thing for companies. The higher the revenue, the more money that company is bringing in. The next one, a sale for which payment will be received at a later date, is called a sale on account. That is still revenue. A sale on account, that's different than when a company sells something and they get paid right away. A sale on account, they sell a good or service and they give the buyer maybe 30 days to pay them. So that's a sale on account. It is important to know that even if no cash is received, a sale is recorded at the time of the sale. Okay, so even if you're going to give the company 30 days to pay you, you're going to record that sale at the time that you make the sale. This is really important because it's also one of our GAAP rules. So in your reading guide, the realization of revenue, this GAAP rule is revenue is recorded at the time of sale. If a company makes a sale on December 15th of 2020, they will record it on December 15th as a sale, even if they're giving the other company 30 days to pay them. It'd make a lot of changes in the value of a company if one company records it on December 15th and a different company would record that sale 30 days later when they receive the money, and it would be included in 2021's financial statements. So it's really important that all accountants play by the same rule book, and realization of revenue states that you will always record the sale when revenue is recorded at the time of the sale. So we have a couple transactions in 1-3. Transaction number 6, we received cash from sales. I think it's really important to go through 3 steps. Step number 1, what 2 accounts are being affected? We have cash and we have our revenue. Revenue is one of those new accounts that affect owner's equity, which is the value of the company. So cash and revenue. Received cash, so that increases by $1,100, just like if we get a check for our birthday, put cash in our savings account, the value of cash goes up in our savings account. Anytime we have sales, also known as revenue, that increases the value of our account. So $1,100 in this case. Our next transaction, transaction number 7, the 2 accounts that are being affected, said we sold services on account to Main Street Services. Well, we had sales. Like I said, regardless of whether you get the money at that time or you're giving a company, in this case Main Street Services, 30 days to pay you, it doesn't matter. You are going to record that sale on that date. So we have a $500 increase in revenue, but we are also going to increase the value that accounts receivable - Main Street Service owes us. So we're going to add $1,500 to their account because they now owe us $500. So maybe we gave them 30 days to pay us. Doesn't matter. We're still going to record the transaction at the time that the sale was made. So if you are taking a test and you have these values here, we have our balances for each account. It's just good practice to add up the left side of the equation and add up the right side of the equation just to make sure that our accounting equation is always in balance. So that is what this slide is showing you. All those balances at the bottom were added. Left side equals the right side, and we're good to go. Okay, talking about liabilities and expenses. When we think of liabilities and expenses, they might seem like they'd be similar, something that's costing us money when we owe someone or when we have expenses, but it's different. Liabilities are when you owe someone money. They gave us 30 days to pay. We'll pay them in 30 days. Expenses, that is the cost of the goods or the cost of the services that are required to operate a business. So you will have an expense, and it might not mean that you owe someone money. So that's the difference. So it says, remember, in your reading guide, it says, remember, expense is the cost of doing business, whereas a liability is debt owed to someone. It can be easily confused because they both seem similar, but they are not. So we have a transaction here that we paid cash for a communications bill for cell phone and internet services, $80. So we paid cash, so that account, cash, is obviously being affected. And then cell phone and internet service, that would definitely be an expense to our company. Expenses, the opposite of revenue. Revenue increases the value of our company. Expenses decrease the value of our company. So our transaction is going to look like this: a decrease in $80 to cash and a decrease in $80 to our owner's equity account because we had an expense that lowers the value of our company. So it has nothing to do with liabilities at all. Expenses lower the value of our company. The only liability accounts that we will ever have are something called accounts payable - any company. Liabilities can only be an accounts payable account. Another expense here, paid cash for equipment rental, $400. So decrease the value of our account, cash account, just like when you swipe your debit card, lowers the value of your checking account by $400. So we have a decrease of $400 on the left, decrease of $400 on the right to our owner's equity account. The last thing that we're going to talk about that affects the value of our company, we also call owner's equity, is a withdrawal. So a business owner, they can use the money that they earn for personal use, but they have to do something called make a withdrawal. We learned in 1-2 that a business owner can't just buy a boat and say that's an expense of their business. The owner needs to withdraw money from the business account and put it into their personal account and then purchase a boat. So obviously, if you're a sole proprietor and your company is making money, you want to be able to spend that for personal expenses, but you can't have personal expenses and business expenses coming out of the business account. So owner will make a withdrawal, take money from the company, withdraw it, put it in their personal account, and go from there. So withdrawal affects owner's equity, and it decreases owner's equity. So we have a couple transactions here. I'm going to start with transaction 11 down at the bottom. Michael Delgado withdrew equity in the form of cash, $350. So he could do that. He's the owner of the company. So he needed $350 maybe for a personal expense. So he took $350 cash. So it's going to decrease the value of cash, and $350 decrease to our owner's equity account. Negative $350 on the left, negative $350 on the right. Our accounting equation balances, and we're good to go. Transaction number 10 at the top, received cash on account from Main Street Services. So they owed us money. We had accounts receivable of $500. They paid us $200 of that. So we're going to decrease the $500 by $200. Now they only owe us $300. And we're going to add $200 cash. So plus $200 and minus $200, those cancel each other out. And our accounting equation is in balance. So we talked about 3 different things that affect owner's equity. Revenue, doesn't matter if we get cash or if they're paying us later, revenue, or sales, that increases owner's equity. Expenses decrease owner's equity, and withdraw decreases owner's equity. So those 3 different things change owner's equity, some positive and some negative, and that is section 1-3.